Guys, thank you all for having us. I'm Nico Lupin. I'm a sophomore at NYU Stern.
I'm Al Kabatis, also NY Stern.
And I'm Tony Wang, also NYU Stern.
And today we're going to be pitching short Griffon Corporation.
There you go. Okay, yeah. So getting into the pitch, we think that Griffon Corporation's margins and earnings profitability power are in decline, and there is substantial room for short. Griffon Corporation is an American conglomerate with two substantial business segments, HBP and C. The former represents 90% of their overall EBITDA contribution and is the US's largest manufacturer of garage doors. The latter is a manufacturer of power tools. We won't really cover it in this pitch because of its small EBITDA contribution. But in short, we think that HBP is significantly over-earning because of elevated garage door prices that are soon correct.
Going over the company a little bit, Griffon is the largest player in a very fragmented market, and their HBP segment is one of the United States' largest garage door manufacturers. Their subsidiary Clopay makes residential garage doors, and Cornell Cookson makes commercial ones. They sell these garage doors to both distributor installers and to major retailers like Home Depot, who then sell these directly to consumers. You can see their revenue mix there. Residential R&R, repair and remodel, accounts for their biggest source of revenue at 48%, followed closely by commercial revenues, and then residential new builds, relatively small at 8.4%. Over 90% of their sales happen in the United States. Looking at competition a little bit, their major competitors are Overhead, Amar, CHI, and Raynor. And the top four manufacturers account for around 70% of market share. And there's also a long tail of smaller regional manufacturers that account for the remaining part of the market.
So what is this investment setup? So essentially in 2022, after COVID, there were a lot of supply chain issues, which caused prices to rise sometimes 100% higher than they were before. And so Griffon started earning a considerably higher EBITDA margin, and they were trading at around 4 or 5x EBITDA. Market didn't believe that these prices were durable until those prices were sustained over 2023 and into 2024. And now in the first half of 2024, the market finally believes that this pricing is durable. And so they're now pricing this company, they re-rated to about 10x EBITDA. So essentially the bull view, the consensus view is that pricing is durable, that volumes will not be dropping as much, and that a quick recovery macro will be able to sustain this. And additionally, management is rational and is doing what they can for price appreciation. We think that HBP pricing in particular, this is the garage door segment, is under enormous pressure due to the evidence that we uncovered, that from weak macro, from a mix shifts, so lower product prices, and from pressure from competitors. And it presents a compelling short opportunity given that they are at comp short interest and they're at GC borrow.
And that brings us to our first investment thesis, which is that Street underestimates Griffon's demand and mix pressure. So first, to set a macroeconomic backdrop for this pitch. Now, Street's case on Griffon's margins holdings relies on macro improving dramatically and staying constant now. But the truth of the matter is that macro in 2024 is much weaker than where it was in 23. So the first point here is that garage doors are commodity products. There's no fundamental difference between a garage door manufactured by company A versus company B. And as a result, a lot of this demand is based on overall macro demand for garage doors. Now, every single metric we looked at is down year over year. The leading indicator of remodeling activity, the LIRA index, is down mid-single digits, while commercial construction spending is down about mid-double digits, about 14% from September 2023. And just to validate this thesis, we got on the phone with about 20 different Griffon distributors who have all collectively mentioned a lot of residential buy down and lower demand in 2024. So they're mentioning that number one, people are buying less expensive doors, and number two, a lot of people aren't buying doors at all.
And the impact this falling demand has is twofold. One, distributors are discounting, and two, competitors are discounting. Let's talk about the distributors a bit. Given lower demand, smaller distributors, we think, have been discounting since late 2023, and we got this Vegas call. Home Depot, Griffon's single largest individual distributor, has been discounting Griffon's products since Q2. And given that Q2 is usually Griffin's strongest quarter, we think this is quite unusual, as you can see the discounting over there. And data from pricehacker.wtf, which aggregates historic price data, also shows that average pricing for low-pay products at Home Depot is down 13.4% year over year. This also goes for Griffin's competitors. Single largest competitor, Overhead Door, reported sales prices down double digits year over year. So you can see that graph over there. And they're also proactively discounting to protect volumes in the face of lower demand, according to their management. And regional manufacturers, again, seem to be doing this as well. And we got this also in the takes call.
So why haven't we seen that with Griffon? Well, one of our thesis is that there's a supply chain lag here. A lot of these contracts with the distributors last a year. A lot of them from Tega's call, it's originated in fall of 2023. And so these are now coming up for renewal. There's a lot that's happened, as we have covered, since fall of 2020. And so what's going to happen to Griffon's margins? Well, this can get catastrophic. If you look at this index to 100 from 2020, pricing has increased nearly 60%, while volumes have stayed the same. And so essentially what's going to happen here is if they have to discount pricings, like all these indicators that we've found show, then their EBITDA margins are going to take a significant hit. Only a 5% decrease in average selling price can result in a 17% EBITDA decrease. And so Street is modeling that EBITDA is going to continue to rise steadily because they don't think that pricing is going to take a hit. Volumes have been negative for 6 straight quarters for Griffon. Pricing is going to follow, as we have shown with this evidence.
All right, and that brings us to thesis 2, which is that we can't trust what management is saying. In short, Street thinks that management's guidance is reliable simply because they have been sandbagging for the last 8 to 10 quarters, continuously underreporting their guidance relative to actual results. Now, the thing is, management isn't all that reliable. Let's start with the CEO, Ronald Kramer. He's the son-in-law of the former CEO. He's the son-in-law of the founder. Get what the point I'm trying to make here. And he's a piece of work. So Kramer has been paying himself an outrageous total compensation for the last 13 to 14 years. As a percentage of net income, it has been historically over 20% versus roughly 3 to 4% in the average peer percentage as a percentage of net income. He's also filled the board of directors with his own personal handpicked candidates, which means that he effectively can do whatever he can or would like to. And lastly, he also does plenty of insider self-dealing. For example, Griffon purchased a fan company in 2021 at a very high double-digit EBITDA multiple. One of the primary beneficiaries of that deal is Griffon's own independent director. That brings us to the insider fight, which Al will cover now.
Yeah, so these governance issues and the value destructive actions of management prompted a proxy fight launched by Boss Capital in Q1 2022. They were ultimately successful. And their 4 goals, as you can see here, were divesting the defense segment, reducing management compensation, selling off HPP entirely, and improving CPP margins. Out of these 4 goals, they were only able to complete 1, which we think was mostly due to hostile management and, their entrenched board. And after all this happened and they couldn't realize all of their objectives, still making a healthy profit, Boss Capital exited 70% of their position in Q1 24. Which we think really limits that upside risk there, where Boss Capital continues to create value from the inside and pressure management. They've been trying to do it. They did it to a certain extent, not really. And we think they're out and they're going to continue to move out going.
And lastly, insider sales at a magnitude that this company hasn't seen, chiefly from Ronald Kramer at ridiculous numbers, but more importantly, from 2/3 of the board of directors and the C-suite. The number of unique managers and board of directors that have sold insider sales has skyrocketed over the last 6 to 8 months. Why would a management for a company that is supposedly doing well in a rough economy be selling stock faster than they've ever sold stock before?
And touching over some key risks and catalysts here, our primary catalyst and the main driver for value realization here is margin and top line revenue compression in the following earnings call. So we think if Street sees that these volumes, these prices aren't sustainable, and the story is fundamentally changing, that is what's going to prompt the stock materially. Some other catalysts are also additional share sales from management, again showing their continuing on the company, and further observe margin compression as well from competitors. Key risks are macro being strong, buyout risk, the company potentially being sold off, as well as input costs, mainly steel, falling going into the next 12 months.
All right, and quickly going over valuation, we valued Griffon on a DCF basis with roughly a high single-digit delta from street when it comes to their pricing and consequently revenues. This DCF model yields a mean downside of 43% from the current share price, weighted as their growth rate and terminal multiple methods. And that's all we have today. Thank you for listening.
Hi, guys. Good job. It's Paul Enright. Can you give us the dumb math, right? Like, could you just say, like, industry volume should grow X, industry volume should be, industry pricing is historically or should be Y, and they should or should not lose share over time, and therefore normalized margin should be what?
Yeah, of course. So we think on a normalized basis, industry volumes grow roughly at inflation 2 to 3% per year. Pricing is a little bit harder to understand because it is very lumpy. Typically, these manufacturers will try to put in a 7% price increase every 2 to 3 years. But we think that both of these factors are probably moving on a low single-digit range out towards the future. Now, as far as where we think it moves in the next year to 2 years, we think that volumes for Griffon are at best flat to low positive, potentially negative if we try to hold their prices flat. More likely, volumes are flat, low positive, while pricing by 5 to 6%, which we think is enough to create substantial pressure on their EBITDA and consequently to street consensus.
This is Eric from Gumshoe Capital. Can you guys hear me?
Yeah, we can.
Cool. So full disclosure, we were short this company. And we did a lot of work on it, but I have not done work on it in probably 6 or 7 months. When did you do the bulk of your calls? What and that survey work? What date was that done over? What time period?
That was done over the last week, and then the first set of calls were done about 3 weeks ago.
Yeah. So
Okay, so all those data points are within the last 3 weeks. And then the data point on the year-over-year price declines in Japan, did they put out their results recently, or is that from last quarter?
Yeah, so
That they said that.
those are for their quarter ended June. So they reported that in mid-August.
Okay, got it. I'm curious. So we did, as I mentioned, we did a bunch of calls on this. We had, like, logically, this makes sense. I know other people have done work on this, and at least as of like 3, 4, 5 months ago, the narrative from distributors was, the market's cooling off a little bit, but like prices just don't go down in this industry. I think the industry like to talk about like there's never been price declines ever in the space. I think our other impression was that kind of everyone benefits when prices increase. Everyone obviously except the consumer, but the majority of consumers, this is a one-off purchase. It's not something that they do regularly, and there had at least up until, again, 3, 4 months ago, there'd been some discipline around pricing. Just everyone kind of continued to hold the line on pricing, not only the manufacturers, but also the distributors. And I'm curious if in your calls, if there was any reference to erosion in the pricing or competitive environment over the last 3 or 4 months specifically, or if it sounded like it'd been bad for a while, just because it flies in the face of what, work we did 6, 7 months ago. I totally believe it's happening. It's just interesting because I think up until at least 3, 4 months ago, there weren't as many clear signs of this.
Yeah, so actually one of the calls I took, and I guess the call that we thought was like the most catastrophic in terms of pricing and the information we received was, one of the distributors based out of, I believe, Texas, was saying that essentially to get anything out of the door, even the cheapest products, he was having to discount his products quite significantly, and things have changed substantially since the start of the summer. So I think that was one call that really stuck out, where things have really materially changed, and now to get product out of the door and clear their inventory, products all across the board had to be discounted quite substantially.
Yeah. I was just going to add, I think as far as kind of distributor demand goes, based on our calls, we think things have, as Alps just said, gotten worse over the summer. I think there's also the added dynamic of kind of where are the competitors going to go. So I think there have actually been 2 instances where competitors did lower prices. Allegion did that in 2022 based on a biggest call, and then the same thing happened with their big competitors, Ken went over literally this year. So based on the fact that their competitors are discounting, we think the same thing could very well happen to Griffon.
And just to add to that, Griffon reports they used to report their price change year over year. They stopped doing that 2 quarters ago for the first time since they started reporting it. So that was one of the big red flags that we identified. They keep reporting their volume year over year growth, but they stopped with their price.
3 more minutes.
Excellent.
Three more.
Thank you.
Might that disclosure change of the act of stopping reporting HPP pricing growth, might that be a signal that our friend Ronald Kramer sees this coming, and if there's a potential acquisition of that segment, could he be using that as a potential exit of the business that has margin pressure?
Right, of course. So we did really think about acquisition risk as one of the big downside risks with this trade. And the reason we're not too worried about it actually goes back to insider sales. So the fact that they stopped reporting this figure 2 quarters ago is definitely curious in itself, especially coinciding with Griffon missing margin targets by 250 basis points this past quarter 3, 24. As far as acquisitions go, we don't really think it makes sense because everybody on the executive board is selling stock. So it seems a bit counterintuitive for them to first sell stock and then sell HPP at a 30% premium to, like, say, the overall value of the business. It just doesn't quite line up. The other factor here is that management did try to engage in talks back in 22. That ultimately ended with them saying that their own strategic plan was better for shareholder interests. And one last little thing to add on this is that Kramer currently pays himself all in cash. So he used to have a big SBC component. He cut that after the activist fight. So overall, I think the picture that management paints is that they're much more concerned with their own salaries and operating the company to pay themselves rather than actually realizing value for shareholders, either through a divestiture of HPP or any other division.
Maybe time for one more question from the judges.
Can I ask 2, Brett?
Sure.
The first one's short. I'm curious how you sourced this idea. And then number 2 is talk a little bit about how you would think about valuation and real world trading this that doesn't involve using your DCF.
Okay, yeah, of course. So the way we source this pitch, so we were all, I guess, working at funds, and one of us over the summer encountered a Substack article about Griffon, and that specific fund manager was actually talking about why he didn't long the stock. So, he liked the investment, but he thought margin pressure could be there and he didn't want to bet on it. So when we saw this, I guess we discussed and thought it was quite an interesting idea because on one hand, maybe margins are durable, but on the other hand, if margins aren't durable, could there be a short opportunity? So the first thing we did then was do a couple of diligence calls, and this happened back in July, just to see if there was any kind of weight to the thesis. So that's kind of how we sourced the idea. As far as valuation goes, I think when you look at the comp set, there are definitely a number of comparables that trade higher as far as what's contained in the comps table, for example, like there is also a rather poor acquisition record in terms of their competitors were acquired at very high multiples. We're talking in the order of 13 to 14 times forward EBITDA when they were acquired. I think our counter argument to this is that these acquisitions happened in fiscal year 21 when multiples were very high and interest rates were low. So there's very little comparability between those trading multiples and where Griffon trades at. And at the end of the day, the current multiple that this stock trades at is the very high end of where it's traded in the last 5 years. We feel that this inherently itself prices in durable margins, which we don't believe to exist.
For what it's worth, the CEO sold again today. 1.3 million.
Nice job, guys.